2025 and 2008, there's some similarities. We're going to discuss how similar they are and how different they are in this episode of The Den.
The Den, powered by the Lyons Group, a show that explores trending topics in real estate, entrepreneurship, and personal growth. We're a small team of professionals with over $400 million in sales and nearly 2,000 successful transactions. You're listening to time-tested experts and industry leaders. Here's a refreshing look at real estate happenings and more. Welcome to The Den.
Hello, everyone. Welcome to this episode of The Den. And today we're going to talk about today's market, 2025 versus 2008. There's been a lot of similarities drawn. A lot of people saying that there's a big crash that's coming up. And we want to talk about that today in this episode of The Den. But before I get to that, let me introduce my friends, my partners, my co-hosts, the fellow members of the Lyons Group. To my right, Paul, Hammy the Rockberry, Aspen the Ninja Gruen, and the boss, Shannon Martin Martinez. My name is Ben, Big Crash Lyons. I don't hit things softly. I mean, if you're going to wreck something...
It's because you're heavier than most.
I got more inertia. Is that what it is?
I got a pretty good story about you in a wreck once, but
I
don't know if we're telling it today, but yeah.
Well, we should
We should call you Crash.
Yeah. Was that the one with
the four-wheeler?
Yeah. Oh, man. Ooh, man, that was rough.
Well, I've played racquetball with you, and I know what happens when...
Yeah. No. More inertia. But this is not, what is that? That's not economics. What is that?
Physics.
Physics. Thank you. This is not a physics podcast, people. This is a real estate podcast. And we are going to talk about, I've heard a lot lately about, hey, there's, what's going on with the market? Is it going to crash like 2008? I mean, there's a lot of people out there thinking that this is the same market that we had back then when we had the big crash. And today we want to talk about that. We want to maybe dispel some theories out there, or maybe add to some theories. You never know. I mean, we're big theory people. Right, Paul? I guess.
Conspiracy theories.
There we go. That's what I was talking
about. Conspiracy
theories. Okay. So let's just start off with some baseline things, like how many homes were sold in 2008 versus 2025. This may shock you, but back in 2008, there were 4.1 million homes sold, and in 2025, or I should say the last 12 months, the number's lower. Mm-hmm. It's actually 4.08 million homes, which is pretty surprising because back in 2008, in America, there were over 300 million people. I think the total was 304 million people in America. Now we have almost 50 million more people. We're at close to 350 million people in America. So when you start comparing things like, man, we have lower sales for homes, but we have 50 million more people, something's going on. Something's going on there. And you think it's just a slowdown of the market as a whole? No, Paul, I'm going to kick it off with you.
There are myriad factors in this. I mean, I don't like the comparison with 2008, but that's just me. There could be a lot of things, but the 2008 crash was because of poor lending practices. Right now, we have very elevated home prices, much higher interest rates. I was looking, we're on average 2+ points higher. And the thing that hasn't grown since 2008 is wages. So the market's running away from people. And, this year's been a little bit tougher too, because construction costs are still higher. I know new homes are selling better than existing homes, but we're still in like one of the worst housing years in the last 50 years.
Yeah, it's pretty incredible. I mean, when you're saying prices are running away from people, I mean, that makes a lot of sense. Is that how you feel it, Shannon? Like you just feel like the prices are just getting away from what the normal person or family makes and can afford?
Yeah, because I think 20 years ago, even somebody right out of college or even high school could buy a house. And that's definitely not the case now. Even some people with 2 incomes in their family can't buy a house. The prices have gotten really, really hard.
So dual income and rising prices, but the wages haven't caught up. That's what you're saying, Paul? Is the wages themselves haven't caught up with the appreciation of the assets?
I don't know. I mean, maybe that's true on paper. I don't know if I necessarily agree with that, because I mean, I can remember, when I bought my first house, when I was making just kind of current wages, but it was still only $7 an hour.
Yeah.
And
my daughter just got her first job at $18 an hour. That's starting in Durango.
And I'm sure she's like that's pretty much poverty level.
Poverty level.
Mm-hmm. Right.
If you were looking to buy a house, like if she was 20, 30, trying to buy a house, it's really hard to buy a house with those numbers.
Well, we had some stats of maybe a month ago or so that came out that we were saying the average median income and I forget what it was, so I'm just thinking in like the 80s was $40,000. Average home was $85,000. Now the average income is $80,000. The average home is $350,000.
Right.
So just in using those, everything's appreciating way faster than the wages are going up. Mm-hmm. So I think, and not only that, cars are getting more expensive.
Right.
Groceries. I mean, all the things that we talk about every day in this economy.
And you're not wrong about that. You're not wrong about that. And maybe the way I see it is, I just think it's not always about just raising wages. I guess that's my perspective of it. I don't think raising wages necessarily, it does help, but then everything else just inflates.
We also have a huge housing shortage.
Exactly. There's so many factors in there. So I didn't mean to kind of dumb down your point. You are accurate in what you're saying.
Dumb him down, Shannon. Dumb him down.
No, I think you're accurate in what you say. I guess my perception of it is just I don't see it as that simple. Like if wages just caught up, I still think we would be having a crisis with housing. I still think we would be having problems. I think we have a lot of factors in there that are causing it.
There are a lot of factors. And I think the wages thing is a whole other conversation, but I think that's more fiscal policy.
Well, it is a huge problem. Wages are a huge part of it, because whenever you have people like in their 30s that can't afford to buy a house in the area they're living in, now you have almost dead neighborhoods where it's just older people. There's no kids running around. There's no, life in the neighborhood. And it's just not, the trickle down just isn't really happening as much because people can't afford to buy a house. Now, we are lucky to live in an area here where we can find things for a reasonable price. Mm-hmm. But most of the country is not in that same.
Yeah, we are way under the national average.
Even still, though, I pulled stats for numbers of what people in our area are making on average and what they are, like what house they could afford technically. And with the wages in New Mexico, I did New Mexico as a whole, and the house prices, it's about an average of $160,000 house.
Right. And
we know what that looks like.
There aren't houses in that price range.
If
on rented land.
Yeah. So, but we also need millions and millions more homes on the market for the U.S. as a whole. And whenever, lumber is being tariffed and we get most of our lumber from Canada, it's a big issue. Everything, though, it's a bunch of things coming in making this housing crisis.
And I think that's my point. Like there is so many factors there.
That's what I said at the beginning. There's myriad factors, but I think one of the other things is a conversation we just had before we started with your house and the very low interest rate. And that's why houses are not hitting the market.
Why would you choose right now to trade up if you're at a 2 or a 3% interest rate?
Exactly.
There would be no reason to.
A house for twice the cost.
That's right. I'm going to buy a house twice as much as what I owe on this one, and I'm going to pay twice as much for the money that I borrow on it. Mm-hmm. Most people aren't going to take that deal.
You didn't get a raise to make that. To make that difference. So
people aren't going to take that deal.
Most people, I think this one is more of an economic crisis. Before it was foreclosures. In 2008, it was a lot of.
I think it was bad lending.
Bad lending. So because people could not afford the loans that were given out. So once they all defaulted, I think that's what caused the bubble crash in 2008.
What did you guys call those loans?
Fogger loans. Yeah. Like if you could fog a mirror, you could get a loan. And
I got one.
Yeah.
I think that's why we're not seeing as many foreclosures. Like we're seeing a regular amount of foreclosures start to pop up, but we're not seeing like the droves.
Well, and here's the difference. In 2008, any guesses on the percent of homes that sold that were distressed? Paul, any guess on a percent of homes.
Distressed, like foreclosed? Or?
Well, not
Behind
fully,
on payments or just having
short sales situation, behind on payments, needed to get out from under it.
Well, 2008 it started, and 2009 and 10 were probably more, right?
We go to 2008
Yeah.
just because that is the benchmark, yeah. But that was the beginning of the decline.
I have no guess.
I'm going to say 35%.
Ooh, that's a good guess. Shannon?
I love a guess.
I don't really know, but I was here during that time and it felt like it was everything. I would say 50%. It did feel like it was everything.
Paul, give a guess.
Another
Everything.
guess. Come on, Paul. You can't get it.
Yours 35?
Yeah.
50?
50.
Oh, he's going to.
51.
Oh, you should have gone the other way
Dang
with
it.
it. 49. It's 45%.
Holy cow.
Almost every other home, Shannon.
That's how it felt.
Felt that way.
Yeah.
Like every other listing we had was like, oh my gosh.
Yeah.
These
They
people
lost
are
their job.
underwater.
They've already moved out. They're 4 payments behind.
Yep.
It felt like it was every home on the market.
Short sales were just left and right. Like you had to understand and be able to navigate short sales. Otherwise, you just couldn't navigate the market. I mean, it was just part of commonplace.
At this point, I haven't even seen a short sale in so many years. I probably wouldn't be too sharp on handling one, but
I have
back
one on the
then
market
it was
right
all of
now.
them.
I have
All of
one on the
them.
market right now, so we can learn together.
Yeah, I need a refresher. It's been a long time.
What a horribly sad time to be working too, just like mentally.
You know what? It was very defeating because coming off of, maybe, the 2002
.com,
to 2005, where the market was really good and you were a rock star. I mean, you could get anybody into a home that came to you, and anybody that needed to sell, you could sell their house. I mean, you're going to sell it within 30 days. We were rock stars. From going from that to being able to all these people calling you back and wanting your help again, and you're just defeated. And I have no market to sell your product in. That was a whole different curve in our that's why so many realtors left. It was very disheartening.
Yeah.
Yeah.
It was very disheartening.
What do you guys anyone know what year credit became a thing? Because it wasn't it after?
Yeah, it was the
2008?
Dodd-Frank
Yeah.
Act that kicked in after the fact, and really put some lending guidelines into place on a federal level that really brought forward the credit component. The DTI really enforced a lot of those things that should have been enforced before. And in New Mexico, actually, it took and threw owner finance into the Dodd-Frank Act. And we fought and actually got it removed because it would have forced owners to qualify buyers if they were selling them a home on owner finance. Remember that?
Yeah,
fight,
and that is
Shannon?
so unfair. That's the whole reason in doing owner finance is that two capable people can decide amongst themselves how they want to do business. And now to force them to say, no, you're going to follow. I mean, I understand following certain lending laws because there's certain fairness involved. That was
But
that was not good for
they did
people.
work it in, and I think they worked it in an appropriate way in the sense that if I'm selling 3 or more homes on an owner finance in a year, then do I have some culpability there? Do I have some responsibility to be able to make sure that these people I'm selling homes to can afford afford the payment?
Because it does turn into, let's say, when we talk small, 1, 2, 3 in between people who live in the same town, and you could turn that into a bank situation really quickly where these huge corporations come in and they go, we're just doing owner financing. But really they're acting as a bank. So
Yeah.
I can see why there has to be some restrictions.
So they threw that in there just to protect the consumer, but not inhibit the homeowner who needs to sell on an owner
Right.
finance. So that was one of the key things. Do you know what the interest rates were back in 2008 versus today? Any guesses?
I bought mine at 5.5.
Good guess,
I really don't know.
Aspen.
I would say
Throw it out there.
I was going to say, okay, I'll say what I was going to say before I heard Paul's. I was going to say like 10%,
10%.
which I now know is high.
Too high.
But that was my guess. And I'm sticking to it.
That's right.
You only get one.
You were and in your credit, I mean, you were still in what, high school then?
Middle school.
Middle school.
I was in 8th grade.
Middle school. Holy cow. Okay.
you were in
Shannon,
8th grade and we were selling houses.
Yeah, yeah.
Wow.
I'm over there like thinking about buying my first car. My parents are going through like
Yeah.
Yeah, crisis.
Holy moly.
didn't know all that was going on, to be honest.
Was NSYNC still a thing? And
Yeah.
Okay.
Backstreet Boys was more popular.
Oh my gosh. Okay. Shannon, what was your guess?
I don't really remember. I would say around 5.
Around 5? Okay. A little bit higher. It's actually 6.17 to 6.19, which is almost identical to today. The average 30-year mortgage is 6.17% right now in America. So there's definitely some similarities. I can see why people are saying this feels very much like 2008, but there are some big differences. Now here's a guess. What's the percentage of distressed sales now? We just said there was 45% back in 2008. What's the percentage?
Are we talking national, probably?
National distressed sale properties. What percentage?
I think under 20%.
I think the average default on FHA is 10.
Okay.
So I'm going to say 10.
Yeah, I don't know. I mean, I'd have to agree with these guys somewhere
So-
in there. I didn't even look that up. I don't know.
This was shocking to me, but I Googled this morning and it said approximately 1% of sales are distressed.
You know what, though? That kind of makes sense because there were so many like furloughed payments and you couldn't foreclose on houses and you couldn't do anything until recently. So it kind of makes sense that there isn't that many because I feel like maybe in the next year or two we'll start seeing
some more. We're starting to see the foreclosure inventory is starting to ramp up.
Yeah, the moratorium's been lifted and they're starting to put more on the market. So
1% distressed sales now.
I got that one.
Yeah. Yeah. Good work. Yeah. Price is right. Getting us there. So that really is a low amount when you start thinking about the distressed sales, but let's talk about days on the market. Average days on the market back in 2008. Remember, Shannon, we'd be like, oh my God, another listing.
like 9 months.
Yeah. I
You
got
didn't
another
even
listing.
want a listing. You
didn't
just
even want
wanted a
listing.
buyer.
Yeah. You didn't want a listing
Yeah.
back then. It was just crazy. What do you think the days on the market back in 2008 were? Average in America. I mean, I know what we experienced, and it just
I don't
seemed
know,
like forever.
100, 200,
I'm going to say 280.
280? You said what?
100 or 200. I don't know. I mean, it was a lot. It was a lot.
150.
150. Paul?
I was going to say, I don't think that 100 is enough because that's only, there's 3 months.
150 is about 4 months.
Yeah, so it was
Let's say 4 to 6
4.5
months.
months.
Yeah.
120 days. So 4 months on average.
Honestly, that's not that bad. That's what it was whenever I bought my first or sold my first house. They told me it's about 4 to 6 months.
Yeah.
Yeah.
Yeah. So
When
although
I get in, it was 9 months.
no.
I thanked him every day.
Yeah,
Thank you, Ben.
Thank you.
I had a good job.
Thank you for changing my life, not for the better. So I do think that there are some similarities, but there are some differences. So the average days on the market now, let me pull up my sheet here. You are 62 days. So 50% less time on the market.
Is that national?
That's national. So, and it's going up. It's going up because we're starting to see more inventory hit the market, which is a sign that there's less demand and the days on the market is getting longer, nationally speaking.
I feel like though, even though statistic wise, it might look a lot like back then, I feel like it's a whole different set of, I think it's completely different. I think we had a lot of job loss back then. I think we had a lot of, financial crisis back then. I think what we're seeing now, and this is just my opinion, but I don't know. I think what we're seeing now, the difference is that prices, we talked about this, prices have run up so much that we've cut a lot of people out. I think that we're even less of a saving society that we used to be. And now there's a little bit more, because we had a financial crisis, there's a little bit more responsibility on a buyer to buy, and we are even less of a saving society than we were back then. That's contributing to it. I think we have a lot of things colliding right now. We have a lot of uncertainty in our economy, even though we're seeing like this kind of positive momentum, like interest rates are coming down, things seem to be getting a little bit better. I think that our market just has to cool off a little bit before a buyer's willing to get in. They need to have more favorable.
Yeah. Not a fun stat. I mean, right now the wages versus like how much it costs to live is worse than the Great Depression. So I think that is why we're not saving as much, because there literally is not.
There's not money to save. I agree.
Yeah.
Well,
I agree.
And I think we gloss over that so much in everything that we do. We talk about home prices and all this kind of stuff. Our wages have not increased in decades.
The way everything else has.
Yeah,
If everything else hadn't increased.
And prices
not followed inflation.
Prices just skyrocketed under
And
COVID.
here's another
Yeah,
thing
they
that's
did.
going to happen in January 1st. Health insurance is going to increase 90%. 90%. My wife's going to be taking a pay cut because of health insurance.
Wow. That's incredible.
So,
That's what you
and
think
that's happening across the country. And as we're recording this, is a government shutdown. So there's another sector of the economy that's not making any money right now.
Right before the holidays.
Right before, all of these factors are saying we're not headed in a good direction. And for housing is a luxury. Well,
it really, but there's also a there's a shortage of rentals too. But that's also because people aren't building affordable houses. Why would you build an affordable house when there's no tax credits to it, there's no benefit to it, when you could build basically the same price house, put a little bit nicer things inside of it, and sell it for triple. Yep. There's no incentive you can't really blame builders. You can't really blame the people for not doing it.
To say build affordable housing at your expense is exactly what you would have to be doing. Yeah, nobody wants to do that.
You have to incentivize that.
And we priced out new construction 2 years ago, maybe now.
Yeah.
Oh, I bet it's not even close.
No,
anymore.
we're probably $25 more a square foot now because of the tariffs and all that kind of stuff. Just supplies is so much higher.
So you've just built the story. We've just built the story of all these things. The wage is not keeping up. The gap is bigger than the Great Depression between wages and affordability. That's a great stat.
Sad stat.
The cost of health insurance going up. Existing home prices are already up there, right? So that begs the question, is there a market correction coming? Is there a crash that may be coming to some degree?
I don't think so, because we don't have houses on the market. I think because we don't have enough houses, it's not going to correct in housing. I don't think that's the way it's going to correct. I think it will correct in some other way. I don't know what that is, but we just don't have enough houses for it to be.
So you think the demand will always offset the ability for the crash to happen? Because
not always, but right now.
But in this instance, I should say, in this instance.
So I don't think, in 2008, there was a reason to get out of the house because you couldn't afford it.
Sure.
And they were kicking you out. Right now, so many people have those 3% or lower interest rates. They can stay, and afford their home. So I think that's a major difference between the 2 years.
Mm-hmm. They're staying in their house, and they can afford the house that they have. They can afford the house, but the groceries they're like drowning in.
Exactly.
The electric, the utilities, it's other stuff. The health insurance. There's
college tuition.
Should have had her go into Mexico.
Oh my gosh!
We thought it was close enough. But we didn't get it. She was too smart. She got a scholarship that kicked us back to out of state.
Yep.
Oh my gosh. Oh, heavens. Yeah, so you have all these factors coming into play.
What do you think? Do you agree or disagree?
So I do think that there's going to be some form of a correction, but I do agree in the sense that there's just a shortage of inventory. So whether you're sitting on a 2.5% or 3% interest rate, what are you going to do? First thing you're going to do is you're not going to go buy Starbucks as much. You're not going to buy the Heinz ketchup. You're going to buy the Safeway brand ketchup. You're going to do all these things to try to trim off, but you've got to keep your house because you can't move from your home to something else that's less
costs
affordable.
You more to go into a rental.
And so that's what in real estate, we need movement. Movement is key for us. It's part of our jobs, part of our business. We need movement. It's becoming stagnant because people are not wanting to move for those reasons.
I think the car industry and fun industries are going to take a bigger hit because I think people are going to get a more affordable car because you still have to get to and from work. But I think those are what we're going to see is like these things that people are spending luxury money on, which housing is and isn't a luxury. Like everyone should have access to housing, safe housing, but like nice cars, not using public transportation, going out and going to all these fun things that are locally owned, whether that be a trampoline park or a pumpkin patch or, all of these little things. I think we're going to see a hit in that regards because frankly, if a house came up that was good priced, we all have buyers for it right now. We all have buyers for those things and not just investors either. People that are, it'd probably be different in a different city. But right now that's kind of, I think, where we are.
Now we have seen housing inventory rise. So more inventory come on the market for the last 20 months in a row. And that may play into the Fed's decision to lower the interest rates a bit. Now, this is a common misconception probably if you're watching this or listening to it, you think that whenever the feds lower interest rates, automatically that lowers interest rates on mortgages. Mm-mm. And that is not the case. Paul, do you want to talk to that a little bit more?
Okay. Well, mortgage interest rates are tied to treasury bonds. So really people buying the confidence in the United States economy. And what we're having right now is people not wanting to buy into the economy or starting to, but because we are getting better, but the tariff craziness that we've had over the past year, coming out of the last administration and coming into this new administration, they kind of changed everything that the economy was trying to do. So people held off, and that's why we haven't. Economy is getting a little bit better. That's why the Fed feels comfortable lowering rates, but we're waiting on the rest of the world to agree with them.
Yeah, because you have all kinds of factors that go into the Fed's rate. Unemployment, inflation, housing, all of these things kind of factor in. And it's a big lever because we became addicted to low interest rates. And that wasn't necessarily a good thing.
I think that was one of the worst things that could have happened in the economy. The
expectation now is that you can't buy a house unless you're going to get it at 3 or 4%.
Because what was happening to all the good priced homes? Investors were coming in, they were paying cash, and then they were refinancing them for the low interest rates. Mm-hmm. Yep. It was not, I think that was one of the worst things that could have happened for the average home buyer.
Yeah, so
great for investors.
They have to be real careful with that lever nowadays. Mm-hmm. So,
well, one of the other indicators that we look at and the Fed looks at is, when we have a fully employed workforce. So right at that 4%, they think that that's full employment. They'll say, okay, we can ease up on the rates. We, as the mortgage industry, would love it to be higher. The higher it goes, the lower the interest rates, mortgage rates go. So that the unemployment rate is down helps our economy, hurts housing.
Interesting. Yeah, because there's an inverse relationship there. Well, we're down to 2 minutes here, so let's just wrap it up real quick. Shannon, I'm coming to you first. Should you buy now or wait for a market crash? And are we looking at the same type of market?
I do not think we're heading to a crash.
Okay.
I do not. I think buy now, because I think as the uncertainty that we're seeing with all, like you keep referring to the tariffs, and that is a huge uncertainty. People feel like they can't plan the future for their business, and they just don't know what's going to happen with this, and prices are fluctuating all over. That will settle down, and that will get worked out. And as that's happening, these interest rates are ticking down. So you're getting this momentum with some favorable conditions in our market are coming to a head with all these people that have been waiting. I do think at some point we are only going to see an elevation. I do not see that we're going to crash. We're not in the same market as we were in 2008. We've got a lot of good things on our horizon.
Well said. I think that's a very good point, Shannon. Aspen, what are your thoughts? Is it the same as 2008? And should you wait to buy or buy now?
I do not think it's the same as 2008, just because the factors are completely different of why people are being priced out right now. I think if it is in your price range, I think if it's a good time for you and your family to move, I think if it's a good financial decision, it's a good time to buy. It doesn't really matter to me what interest rates could be 14%. And if it still makes sense to you and your family, then it's a good time to buy. But if it doesn't, then it's not.
Well said. Paul Berry, is it 2008 all over again? And if so, should you wait to buy for that crash? What are your thoughts?
No, I don't think it's 2008 at all. I think 2023, 24, 25 are going to be years all their own. When we look back in history, say this was a very different time. And I think this is going to be some of the things that we've talked about today are going to be what policymakers are going to look at and say, our people no longer have the money to live in today's society. We have to make some corrections to fix that. What is that going to look like? Because we can force affordable housing, but like I was saying earlier, somebody's got to take a hit for affordable housing. We need to create the environment where everybody can afford.
And that's very well said. It is an entire environment. It's not one factor.
Yep.
There's a lot.
And I would agree with all of you. I think this is not a 2008. There's not going to be a big crash. There may be some correction. There is some corrections in different areas in the market. But to Shannon's point, as things settle down, as the economy really starts getting moving along, and those things start landing, those pieces start coming together, then we're off to running again. And it is a bigger issue, the affordability altogether, but that's a whole nother conversation. But if you're on the fence, do not wait, because if you wait, then when things do settle and they sit, then you're going to be competing with everybody else. Now is a good time to make the move. Now is the time to buy. To Aspen's point, whenever it's all the pieces are lined up for your family, and that's the right time to make a move then. But don't wait for a crash, because very unlikely that's going to happen. So great conversation. Thank you for that. Thank you for listening to this episode. If you like our content, please go to our YouTube channel, like and subscribe there. Of course, you can jump on Facebook. We post a fantastic newsletter once a week. Thank you, Paul Berry, for putting that together. It has all kinds of great information.
You're welcome.
And of course, you can go to sjcbroker.com and schedule a private consultation with any member here at the Lyons Group. We'd love to sit down with you, whether you're buying or selling residential or commercial. We can give you an advantage in today's market. Thank you for listening to this episode of The Den. Until next time, we'll see you then.
Thank you for listening to this episode of The Den, powered by the Lyons Group. Hit the subscribe button to keep informed, and check the show notes below for direct links to our buyer and seller video series. The buyer and seller video series can give you an inside track on taking the right steps in real estate. If you'd like to learn more about the Lyons Group or to schedule a consultation, go to sjcbroker.com. Complex markets require complex strategies. The Lyons Group can give you a true advantage in any market. Whether you're buying or selling, residential or commercial, contact us directly at sjcbroker.com. We're time-tested experts with a client-first approach, and we'll see you next time in the Den.